In 1974, Henry Kissinger flew to Saudi Arabia and made a deal that would define American power for the next 50 years. The Saudis would price oil exclusively in US dollars. In exchange, America would protect them militarily and provide unlimited weapons. That deal created the Petro-Dollar system, the foundation of American economic dominance, the reason we could print unlimited money without consequences, the mechanism that forced every country on earth to hold dollars. And last week, Iran just proved that system is dead, not dying, dead. Ships are paying transit fees in Chinese Yuan at the Strait of Hormuz. The 50-year monopoly is over. And what Nixon and Kissinger built, what sustained American global power for half a century, is collapsing in real time. This is the end of an era, and most people don't even know it's happening. Let me explain exactly what the Petro-Dollar system was and why its collapse is such a strategic catastrophe for the United States. To understand this, we need to go back to August 1971. And that's when President Richard Nixon ended the Bretton Woods system, the post-World War II arrangement, where the dollar was backed by gold at $35 per ounce. Countries could exchange their dollars for gold, which gave the dollar credibility and stability as the global reserve currency. Nixon ended that system because the United States was running out of gold. We've been printing more dollars than we had gold to back them. Foreign central banks, particularly France, were demanding gold in exchange for their dollar reserves. We were facing a run on Fort Knox, so Nixon simply ended convertibility. From that point forward, the dollar was a pure fiat currency, backed by nothing except faith in the U.S. government. That should have been catastrophic for the dollar's global status. Why would foreign countries continue holding dollars if they couldn't exchange them for anything tangible? Why would they accept dollars as payment for real goods and services if dollars were just paper-backed by American promises? The answer came 3 years later in Jeddah, Saudi Arabia, when Henry Kissinger negotiated the deal that would save the dollar and create the foundation for 50 years of American economic hegemony. The deal was elegant in its simplicity. Saudi Arabia would price all its oil sales in US dollars. It would refuse to accept payment in any other currency. In exchange, the United States would provide unlimited military protection to the Saudi regime. We would sell them advanced weapons. We would guarantee their security against any external threat, and we would turn a blind eye to their internal policies, no matter how repressive they became. Saudi Arabia agreed. And because Saudi Arabia was OPEC's dominant member and the world's swing producer of oil, the rest of OPEC followed. From 1974 onward, if you wanted to buy oil, the most critical commodity in the global economy, you needed US dollars. It didn't matter if you were Japan buying oil from Saudi Arabia or Germany buying from Iraq or China buying from Iran. The transaction happened in dollars. The invoice was denominated in dollars. The payment cleared through dollar-based financial systems. This created what economists call structural demand for dollars. Every country on earth needed to maintain dollar reserves to purchase energy. Oil importing nations had to earn dollars through exports or borrow dollars through international markets. Even oil exporting nations accumulated dollar reserves from their sales and needed somewhere to invest them. The obvious place, U.S. Treasury bonds. Safe, liquid, dollar-denominated assets issued by the same government that guaranteed the system. The implications were enormous. The United States could run persistent trade deficits, importing more than we exported, without the currency crises that would afflict other countries. Why? Because those dollars we sent overseas to buy foreign goods came back to us when those countries bought oil and then invested their dollar earnings in treasury bonds. We effectively printed paper and exchanged it for real goods, and the paper kept circling back to us, and we could run massive federal budget deficits, spending far more than we collected in taxes without facing the borrowing costs that would cripple other governments. Why? Because there was always demand for treasury bonds from countries that needed somewhere to park their dollar reserves. We had a captive buyer base for our debt regardless of how irresponsibly we managed our fiscal policy. We could impose financial sanctions with devastating effect. Cut a country off from the dollar-based financial system, and you effectively cut them off from the global economy. They couldn't buy oil. They couldn't conduct international trade. They were isolated. This gave us tremendous leverage in foreign policy. The threat of being excluded from dollar clearing systems was enough to force compliance from countries that might otherwise resist American demands. The Federal Reserve could print money, quantitative easing, economic stimulus, whatever you want to call it, without triggering the kind of inflation you'd expect when a central bank dramatically expands the money supply. Why? because much of that newly created money was absorbed overseas by countries that needed dollars for oil transactions. The inflation was exported. We got the benefit of monetary expansion without the cost of currency depreciation. For 50 years, this system worked brilliantly for American interests. We live beyond our means. We financed 2 decades of wars in the Middle East. We ran up $35 trillion in federal debt. We printed trillions during the financial crisis and the pandemic. And through all of it, the dollar remained strong and dominant because the Petro-Dollar system created structural demand that overcame any concerns about American fiscal responsibility. Now understand what Iran just did. By charging ships in yuan at the Strait of Hormuz, they proved that oil-related transactions don't need to happen in dollars. They demonstrated that the most critical energy choke point in the world can operate outside the dollar system. They showed that Chinese financial infrastructure can handle large-scale maritime commerce. They created a precedent that other countries will observe and potentially replicate. This isn't theoretical. This is actually happening. Over 200 ships have paid these fees. Millions of dollars in oil-related transactions have cleared through yuan-denominated systems. The mechanics work. The infrastructure functions. The precedent is set, and every shipping company, every oil trader, every energy firm that now has yuan clearing capability is one step further from dollar dependence. Saudi Arabia is watching this very carefully. They're the keystone of the Petro-Dollar system. Their 1974 agreement with Kissinger is what made dollar dominance in oil markets possible. But they've been in discussions with China for over a year about accepting yuan for oil sales. Those discussions have been theoretical until now. Iran just made them practical. Iran proved it works. That changes the calculation in Riyadh. The Saudis are already frustrated with the United States. We didn't support them adequately in Yemen. We negotiated with Iran over their objections. We've been reducing our military presence in the region. We've been pivoting to Asia and treating the Middle East as a secondary priority. Meanwhile, China has become their largest oil customer and a major investor in their economy. The balance of interests is shifting. If Saudi Arabia decides to accept yuan for even a portion of their oil sales to China, the petrodollar system doesn't just weaken, it effectively ends. Because if the world's largest oil exporter can sell in yuan, why would anyone insist on dollars? The structural demand disappears. The captive treasury bond buyers disappear. The sanctions leverage disappears. The ability to print money without inflation disappears. My sources tell me there are extremely worried discussions happening at the Treasury Department about exactly this scenario. Not public discussions, not congressional hearings, but quiet classified sessions about what happens to American economic power if the petrodollar system unravels. The conclusions are not optimistic. Interest rates on U.S. debt would rise significantly. Without the captive demand from oil dollar recycling, Treasury bonds would have to offer higher yields to attract buyers. That means the cost of servicing our $35 trillion in debt increases dramatically. We're already spending over $1 trillion a year just on interest. If rates rise even a couple percentage points, that could double or triple. Inflation would spike. All those dollars currently held overseas as oil reserves would no longer be needed. They'd flow back to the United States. That's trillions of dollars flooding back into the domestic economy. Basic monetary theory tells you what happens when money supply increases faster than economic output. Prices rise, potentially dramatically. The dollar would depreciate against other major currencies. Without structural demand from energy markets, the dollar's value would depend purely on the fundamental strength of the U.S. economy relative to others. Given our massive debts, persistent deficits, and declining industrial base, that's not a favorable comparison. A weaker dollar makes everything we import more expensive, which feeds back into inflation. Our ability to impose financial sanctions would diminish drastically. If countries can conduct major transactions outside dollar systems, being cut off from those systems becomes survivable rather than catastrophic. Iran would no longer be isolated. Russia would have viable alternatives. Even China would be less concerned about sanctions because they'd have established financial infrastructure that doesn't depend on dollar clearing. This is an economic catastrophe in slow motion, and it's being driven not by some sudden collapse or crisis, but by the quiet erosion of the mechanisms that made dollar dominance possible. Iran charging fees in yuan is just one visible manifestation of a broader process. Russia selling oil in non-dollar currencies, China establishing yuan clearing systems worldwide, countries signing currency swap agreements that bypass dollars. Every move away from dollar dependence makes the next move easier. The United States doesn't have good options to stop this. We can't military force countries into using dollars. We already tried that with Iraq, and even if that was part of the motivation for that war, it clearly didn't solve the underlying problem. We can't sanction countries into dollar dependence when the alternative systems already exist and function. We can't simply print more dollars to maintain dominance when the structural demand for those dollars is weakening. Some analysts argue that dollar dominance was never solely about oil. They point to the depth of U.S. capital markets, the rule of law, the strength of American institutions, the network effects of dollar-denominated trade. All true, but the petrodollar system was a critical component that reinforced all those other factors. It created the liquidity that made capital markets deep. It generated the demand that made institutions matter. Remove that foundation and the rest becomes more contestable. China has been systematically preparing for this moment. They've established the Shanghai International Energy Exchange, where oil futures trade in yuan. They've created the cross-border interbank payment system as an alternative to SWIFT. They've signed currency swap agreements with dozens of countries. They've promoted yuan use in Belt and Road Initiative projects. They've built the infrastructure for a post-dollar energy trading system. Iran's actions at Hormuz are just activating infrastructure that was already built. The historical parallel is striking. In the early 20th century, the British pound was the global reserve currency backed by British naval power and the gold standard. When Britain went off gold in 1931 and its naval dominance waned, the pound's reserve status eroded. The dollar replaced it not through some dramatic single event, but through decades of gradual transition. We're now watching the same process happen to the dollar. Not a sudden collapse, but a steady erosion as the foundations of dollar dominance are undermined. Iran's Tehran Tollbooth is significant not because transit fees at Hormuz will destroy the dollar by themselves. It's significant because it demonstrates the vulnerability. It proves that alternatives work. It shows that American economic leverage has limits. And it emboldens other countries to make similar moves, creating a cascading effect where each step away from the dollar makes the next step easier and less risky. The 50-year era that Kissinger created in 1974 is ending, not because the dollar lacks intrinsic value or because American institutions are weak, but because the specific mechanism that created structural global demand for dollars, the petrodollar system, is being dismantled by actors who recognize that challenging dollar dominance is now possible in ways it wasn't before. Iran proved it at Hormuz. China provided the alternative infrastructure, and the rest of the world is taking notes on what's possible. This is the kind of strategic shift that takes decades to fully play out, but looks inevitable in retrospect. 50 years from now, historians will look back at this period and wonder why American leadership didn't respond more decisively when the foundations of dollar dominance were being eroded. They'll study the Tehran Tollbooth as the moment when the practical end of the petrodollar system became undeniable. And they'll analyze how the United States adjusted or failed to adjust to a world where economic power was more multipolar and dollar hegemony was just a memory of a different era. We're living through that transition now. Most Americans don't recognize it because the changes are gradual and technical. There's no dramatic crash, no currency crisis, no obvious inflection point, just steady erosion. One transaction in yuan instead of dollars, one oil producer accepting alternatives, one maritime choke point operating outside dollar systems, each change small by itself. But collectively, they're dismantling the architecture of American economic power that's existed since 1974. What Nixon and Kissinger built is ending, and what comes next will reshape American power and prosperity for generations to come. Let me get more specific about what the practical consequences of petrodollar system collapse will be for average Americans, because this isn't just some abstract macroeconomic theory. This will affect your daily life in concrete ways that most people aren't prepared for. When the structural demand for dollars weakens, when treasury bonds don't have captive buyers anymore, when the Federal Reserve can't print money without inflation consequences, all of that translates into to real economic pain. First, gas prices. Right now, oil is still primarily traded in dollars globally, despite Iran's yuan fees at Hormuz. But as more transactions move to yuan or other currencies, the dollar will depreciate relative to oil exporting currencies. That means we'll pay more dollars for the same barrel of oil, not because oil is becoming scarce, but because our currency is worth less. If the dollar depreciates 20%, which is entirely possible if petrodollar demand collapses, that's 20% higher gas prices at the pump, even if the global oil price stays flat. Second, interest rates on everything. Mortgages, car loans, credit cards, student loans, all of it will get more expensive. Why? Because the Treasury Department won't have captive foreign buyers for our debt anymore. They'll have to offer higher interest rates to attract investors. And when Treasury rates rise, all other interest rates rise with them. Your 30-year mortgage that might have been 3% will be 5 or 6%. That's hundreds of dollars more per month for the same house. That's tens of thousands more paid over the life of the loan. Third, inflation across all consumer goods. This is the big one that people need to understand. Right now, there are trillions of dollars sitting in foreign central bank reserves and sovereign wealth funds and international corporate treasuries. Those dollars are overseas. They're not circulating in the American economy. They're held as reserves for oil purchases and other international transactions. But if those dollars aren't needed anymore, if yuan or euros or other currencies work just as well for international trade, those dollars come home. What happens when trillions of dollars flood back into the domestic economy? Too much money chasing too few goods. That's the textbook definition of inflation. Prices rise across the board. Your grocery bill increases. Your rent increases. Everything gets more expensive, not because of supply chain problems or labor shortages, but because the currency itself is worth less. The Federal Reserve's ability to control this through interest rate policy is limited because the fundamental problem is structural overcapacity of dollars globally. Fourth, the federal budget crisis intensifies dramatically. We're currently spending over $1 trillion per year just servicing the interest on our $35 trillion in federal debt. That's with historically low interest rates propped up by foreign demand for treasuries. When that demand evaporates and rates rise, our interest payments could easily double or triple. That's $2 or $3 trillion per year just to service debt, not to run any government programs. That's more than the entire defense budget. That forces impossible choices about what to cut or what taxes to raise. Fifth, American geopolitical leverage collapses along with the dollar. Right now, we can threaten sanctions and actually change behavior because being cut off from dollar-based financial systems is economically catastrophic for most countries. But if yuan-based systems work, if countries can trade and invest and conduct international commerce without touching dollars, then our sanctions lose bite. Iran proves this already. They're surviving under maximum pressure sanctions specifically because they've developed workarounds. Russia is doing the same. China is building the infrastructure to enable it. Once the alternative systems are robust, dollar-based sanctions become ineffective. Now, let me walk through exactly how we got here, because understanding the decisions that led to this point reveals how preventable this crisis was. The Petro-Dollar system was brilliant when Kissinger negotiated it, but it created dependencies and vulnerabilities that have now become critical weaknesses. The original 1974 deal with Saudi Arabia worked because the Saudis had no alternatives. They needed American military protection against regional threats. They needed American weapons and technology. They needed American political support. And the United States was willing and able to provide all of that unconditionally. So pricing oil in dollars was an acceptable cost for Saudi security. But the world changed. America's willingness to be the Gulf's security guarantor has diminished. We're less dependent on Middle Eastern oil because of domestic fracking. We're more concerned about China and the Indo-Pacific. We're tired of Middle East entanglements after Iraq and Afghanistan. We've been reducing our military footprint in the region for over a decade. From Saudi Arabia's perspective, we're a less reliable partner than we used to be. Meanwhile, China has become Saudi Arabia's largest customer. They buy more Saudi oil than anyone else. They're investing billions in Saudi infrastructure. They're not demanding political reforms or human rights improvements. They're willing to provide weapons without conditions. They're building economic relationships without trying to reshape Saudi society. From Riyadh's perspective, Beijing is starting to look like a better partner than Washington. The same dynamic applies to other major oil producers. Russia doesn't trust the West after sanctions over Ukraine. Iran was sanctioned so severely they had no choice but to develop alternatives. Venezuela faces similar pressures. The UAE is hedging. Even Iraq is exploring options. The unified OPEC bloc that agreed to dollar pricing in 1974 no longer exists as a cohesive unit willing to enforce dollar dominance for American benefit. China recognized this shift and systematically built the infrastructure to exploit it. Starting 15 years ago, they began developing financial systems specifically designed to operate outside dollar dominance. The Shanghai International Energy Exchange isn't just another commodities market. It's specifically designed to enable yuan-denominated oil trading. The cross-border interbank payment system isn't just another clearing system. It's designed to bypass SWIFT and American financial oversight. The currency swap agreements aren't just bilateral arrangements. They're building a network that enables trade without dollar intermediation. This was patient, strategic work over more than a decade. They built the plumbing before they needed it. They established the relationships before they activated them. They created the legal and financial frameworks before they started seriously competing with the dollar. And now when the opportunity presents itself, Iran operating outside the dollar system at Hormuz, all the infrastructure needed to support that is already in place and functional. The United States, meanwhile, treated dollar dominance as permanent and unassailable. We assumed that network effects and institutional advantages would maintain dollar hegemony regardless of how we use that power. We weaponized the dollar through sanctions without considering how that might motivate countries to seek alternatives. We printed trillions in quantitative easing without considering how that might erode confidence. We ran persistent deficits and accumulated massive debts without considering how that might undermine dollar credibility. We took the Petro-Dollar system for granted, and now we're discovering it wasn't as permanent as we assumed. My sources tell me there are now classified studies circulating in Washington examining what's called managed de-dollarization scenarios, not how to prevent the dollar from losing reserve status. That's increasingly seen as inevitable, but how to manage the transition to minimize economic disruption. The fact that this is even being studied tells you how seriously officials take the threat, even if they're not talking about it publicly. These studies examine different timelines. Rapid collapse, where foreign holders dump dollars quickly, would be catastrophic. Massive inflation, currency crisis, potential financial system breakdown. That's the nightmare scenario. But it's also considered unlikely because other countries don't benefit from chaotic dollar collapse. They hold too many dollar-denominated assets themselves. Their own currencies would appreciate too quickly, hurting their exports. It's not in anyone's interest to crash the dollar. More likely is gradual erosion over 10 to 20 years. Dollar share of global reserves declining from 60% now to 40 or 30%. Yuan, euro, and other currencies picking up the difference. Oil markets becoming more multi-currency. Trade gradually shifting to bilateral currency arrangements. Each year, the dollar is a little less dominant, but there's no single crisis point. This is the scenario planners think is most probable. It's also the one they have the least ability to prevent because it doesn't result from any single decision or policy failure, but from accumulated structural shifts. The question for American policymakers is what to do. Some argue for making the dollar more attractive, fiscal responsibility, reducing deficits, building trust in American institutions. Noble ideas, but politically difficult when we can't even agree on a budget and both parties support enormous spending. Others argue for competing aggressively with China's financial infrastructure, building better alternatives, offering better services. But that requires sustained investment and international cooperation that seems unlikely given current geopolitical tensions. Some argue for acceptance, acknowledging that dollar hegemony was historically unique and probably not sustainable long-term, and focusing on maintaining American prosperity and power through other means, industry, technology, military strength, diplomatic relationships. That's psychologically difficult for a country that's treated dollar dominance as a birthright for 2 generations. What seems most likely is strategic drift, no clear decision, no coherent strategy, just reactive responses as crises emerge. That's been the pattern on most major challenges lately. And on this particular challenge, reactive responses won't work because the changes are structural and long-term. By the time the consequences are undeniable enough to force action, the underlying conditions will have shifted too far to reverse easily. Iran's Tehran Tollbooth is important not because UN-denominated transit fees will destroy the dollar by themselves, but because they reveal that alternatives exist, they work, and they're being used in the most strategically critical energy choke point in the world. That revelation encourages others to explore alternatives. That exploration creates additional precedents. Those precedents normalize multi-currency energy trading. That normalization erodes petrodollar structural demand. That erosion weakens all the other mechanisms that maintain dollar dominance. We're watching a complex system unravel, not through catastrophic failure, but through gradual disintegration as supporting mechanisms weaken and alternative systems grow. The petrodollar system Kissinger built in 1974 gave the United States extraordinary economic advantages for 50 years. That era is ending. What comes next will be less advantageous for American power and prosperity. How much less depends on decisions being made right now about how to adapt to a world where dollar dominance is diminished and American economic hegemony is contested by peer competitors with functional alternative systems. Those decisions aren't being made well, if they're being made at all, and that will have consequences for decades to come. The 50-year monopoly is over. History is turning the page. Now,